Hey everyone, welcome back to Corporate Dakota, the place where we unpack massive financial filings and try not to get lost in the legalese. Today we are diving into Newmont Corporation's latest quarterly filings, and buckle up because this one has some wild swings and some really big numbers. Before we dive in, if you appreciate getting straight insights from these corporate documents, make sure you are subscribed. And if you want to discuss this further or have questions, join our Discord community linked in the description below. So what is Newmont telling us about their performance up to September 2025? The headline news is a massive jump in net income from about $922 million in the same period last year to a staggering $1,832 million this quarter. That is a huge increase, and it's largely driven by higher gold prices and a significant reduction in their costs associated with selling their products. They also had a big boost from selling off some of their assets, which is wiping out some old write-downs and actually turning into a gain. Let us talk about revenue first. In the third quarter of 2025, Newmont pulled in $5.5 billion in sales, which is a big jump from $4.6 billion in the same quarter last year. This surge is mainly thanks to higher prices they got for their gold, a $724 million increase for the quarter. Copper sales dipped slightly, but silver sales saw a really nice boost, jumping by $146 million because they sold more and got a better price. Now onto costs. For the same third quarter sales period, their costs dropped from $2.3 billion to $1.9 billion. This is a significant saving and a big reason why their profits rose so much. A lot of this cost reduction can be tied to them selling off certain parts of their business. If we look at the 9-month period for 2025 costs applicable to sales, we're $6 billion down from $6.5 billion in 2024. They managed to cut costs on gold significantly more than other metals. When we look at the bottom line for just continuing operations for the third quarter of 2025, Newmont posted $1.8 billion in net income. That is more than double what they made in the third quarter of 2024, which was around $875 million. For the first 9 months of 2025, this profit figure reached an impressive $5.8 billion, up from $1.8 billion in the same period of last year. This is a massive improvement and signals a very profitable period for the company despite some underlying complexities. Let us take a quick look at their balance sheet as of September 2025. They have cash and cash equivalents of over $5.6 billion, which is a healthy increase from $3.6 billion at the end of 2024. This growing cash pile gives them a lot of financial flexibility. Notice that their assets held for sale have dropped dramatically from over $4.6 billion at the end of 2024 to just $166 million by September 2025. This clearly shows they've been actively selling off assets as planned. And on the equity side, Newmont stockholders, equity stands at over $33 billion, reflecting that strong performance and a healthy balance sheet. Looking at cash flow for the first 9 months of 2025, Newmont generated a massive $6.7 billion from operations. This is a huge jump from $3.8 billion in the same period of 2024. This increase is largely due to those higher gold prices and the impact of their divestitures, which, as we saw earlier, reduced their costs. Financing activities show that they repaid a significant amount of debt, about $3.3 billion in the first 9 months of 2025. They also repurchased a lot of their own stock, reducing debt and returning value to shareholders. Now, about those divestitures. Newmont has been on a selling spree getting rid of non-core assets. They sold CCAMP, V Musselwhite, and Lonor in the first quarter of 2025, Porcupine and Akim in the second quarter, and even agreed to sell the coffee development project, which closed in October. This strategy of shedding non-core assets has significantly impacted their financials positively this quarter. They recognized gains on these completed sales, a total of $904 million for the 9 months of 2025. When we dig into the segment details, we see a mixed bag of performances, but overall strong results driven by their main gold operations. Pesquito in Mexico, for example, delivered $918 million in sales for the third quarter of 2025, a significant portion of which comes from gold and silver sales driving profitability. Their costs applicable to sales globally are down substantially. This is a key takeaway. The company is becoming more efficient, or at least has reduced its operating footprint significantly through these sales. Looking at that net income again, it is clear that shedding less profitable or non-core assets has had a dramatic positive effect, allowing the company to report very strong earnings per S-Hair of $1.67. At their Ahafo mine in Ghana, gold production was a bit lower, but their cost per ounce of gold increased mainly because they sold fewer ounces. However, all-in sustaining costs still went up due to higher expenses per ounce. Pesquito in Mexico saw a big jump in gold production by 40%. This is due to better mining practices with higher ore grades and more throughput. However, their costs went up too mainly from royalties and profit sharing. The average realized price for gold here experienced a massive increase from $2,518 per ounce in 2024 to $3,539 per ounce in 2025. Yanacocha in Peru showed a substantial 63% increase in gold production. This is mainly from their injection leaching operations, which are proving highly effective. Their cost per ounce went down significantly because they sold more gold and their efficiency improved. Newmont operates globally, so currency fluctuations can impact their costs. While their sales are mostly in US dollars, meaning they do not directly profit or lose from currency changes on sales. If they pay their own operating costs in local currencies like the Australian dollar, Canadian dollar, or Mexican peso, those currency movements can affect their bottom line. For instance, a devaluation of the Argentinian peso or Surinamese dollar generally makes their costs in those countries cheaper in US dollar terms. When it comes to liquidity, Newmont is in a very strong position. They have over $5.6 billion in cash and cash equivalents. On top of that, they have $4 billion available on credit facilities, so their total available liquid funds are nearly $10 billion. This gives them immense flexibility to navigate market volatility and pursue strategic opportunities. Their net debt is almost zero at just $12 million, which is a remarkable improvement from over $5 billion at the end of 2024. They have been aggressively paying down debt, which is a smart move, especially in uncertain economic times. This reduction in debt, coupled with their strong cash position, indicates excellent financial management. Looking at their spending on new projects and maintaining existing ones, they've invested over $2.2 billion in property, plant, and mine development for continuing operations in the first 9 months of 2025. A significant portion of this is going into development projects like Ahafo North and Tanami Expansion 2, which are crucial for future growth. Now, for the non-GAAP measures, these are important because they give you a clearer picture of the core business performance by removing certain one-off or non-cash items. Adjusted EBITDA shows their operating performance before interest, taxes, depreciation, and amortization and other adjustments. For the third quarter of 2025, this was $3.3 billion, a massive increase from $1.9 billion in the previous year. This highlights robust operational profitability. Adjusted net income, meaning the profit after removing those special items, also saw a huge jump to $1.8 billion for the quarter. This measure is key to understanding the underlying health of their operations. It is also important to touch on safety. Newmont states they are diligent about strengthening their safety systems and have a unified approach called Always Safe. They highlight their commitment to employee safety and responsible mining practices. Importantly, they no longer operate any US mine sites regulated by MSHA because they sold the CCAMP. V-Mine, which is a significant shift. A quick note from the other information section indicates no new Rule 10b5-1 trading plans were adopted, amended, or terminated by their directors or officers in this quarter. This means any stock trading by insiders is likely happening under existing plans or outside of these pre-arranged programs. And just a small bit of external context from the exhibits, we see a transition agreement with Tom Palmer dated the 28th of September 2025. This might hint at some leadership changes or transitions occurring around that time. My take on Newmont Corporation's latest filing, especially for the third quarter of 2025, is that they are in a very strong position operationally and financially. The divestment of non-core assets has clearly paid off, significantly boosting their profitability and simplifying their business. Their commitment to reducing debt and returning cash to shareholders through dividends and share repurchases, alongside robust cash generation from operations, is a positive sign of financial discipline. The company's strategic focus on optimizing its portfolio while maintaining financial flexibility seems to be working remarkably well. However, investors should remain mindful of the inherent volatility in commodity prices and the ongoing geopolitical and macroeconomic pressures that can impact costs and production. The substantial increase in gold prices has been a major tailwind, and while they have demonstrated effective cost management and operational efficiency, future results will still be tied to these external market forces. The company's proactive approach to debt reduction and strong liquidity position provides a good buffer against potential downturns and opportunities. In conclusion, Newmont is showcasing impressive financial strength and operational improvements driven by strategic asset sales and a recovering commodity market. They are a lean, mean gold-producing machine right now, and their financial health looks exceptionally solid. What do you think about Newmont's performance and strategy? Let us know in the comments below. If you found this analysis helpful, please hit that like button and subscribe for more deep dives into company filings. And remember to check out our Discord community linked in the description to keep the conversation going. Thanks for watching, and we will see you in the next episode of Corporate Decoder.